Hello, everyone. It is March, and this is your March housing update here in the South Bay. This is South Bay specific numbers first. We'll go through those. Then we'll go through exactly what's happening right now with regards to foreclosures, with regards to forbearance, interest rates, and all that good stuff. So what I can do is I can share my screen here with you and go on to here and then present. All right, so this is your South Bay housing market update, March 21st. Here are the stats, the difference between January and February numbers as we have them. We've got closed sales look similar, pending sales look similar, new properties that came on the market. We had a little bit of an uptick in February over January, and that is normal considering we have less listings in December and January than the rest of the year on a cycle year by year by year by year. Month supply stayed similar, 1.5, month supply 1.6. If you're new to the South Bay market update, that is really, really low. Generally, you want between 4 and 6 months of inventory to be a healthy market. We've been under 3 for years now, but now we're under 1. It's a severe low statistic, which I want to show you actually affects one of the things later, one of the big headlines that you see on TV. This will affect that, and I'll show you a great graph later about that. Percentage of list price, we're over 100%. Most places that come out are priced right about where they should go or even lower. Many places sell for over list price. Remember, list price is just an invented number from a listing agent as a marketing tool. So it's not the value of the property. Properties are selling at their market values, but they are listed beneath market values many of the times, especially here in the South Bay. Median days on market is 10. Half of the properties that sell in the South Bay this year, even really for the last 6 months, if you've been watching these updates, sell in under 10 days. It's pretty quick. So nothing really changing here, nothing to watch. We'll see with a little bit more new listings. We'll see what happens with closed and pending next month, but nothing super exciting there. Nothing's changing. It's more status quo, except for mortgage rates. So interest rates have been historical lows. If you've listened to these before, we had 16 historical new lows hit last year in 2020. And now in 2021, finally, about 3 weeks ago, they started to kind of tick up. So generally what that does to the buying market, many people expect, oh, when interest rates go up, prices will come down. I hear that a lot from clients. It makes sense why you would think that. However, that's not really what the market does or not really how it works. All it does is bump people from the price range above down into your price range. So it affects the buying power of the general public, but the general public has buying power in all different rungs, all different price ranges. So if you're looking for $1 million house, interest rates go up. Now you can only afford $900,000. Well, everybody who's looking for a house for $1.1 million can now afford your $1 million house. And generally the public stands still for a little bit to check, to make sure that interest rates aren't going to come back down. But after a little bit of a standstill, and by the way, there's not a bunch of inventory to sit, after a little bit of standstill, everybody will kind of readjust to what the new market is and kind of search for the properties that they've been looking for in their new price range. So hopefully they come back down for everybody. I mean, it's all relative. They went up, 0.5%, 0.75%, which is a lot. However, we're coming from 2.5 to 3.25. They're still historical lows. You're still under 4%, which we have had for much of the time in the last 5 years. So, but this is where they have come from. However, the rise in mortgage rates over the next couple of months is likely to be more muted. They expect mortgage rates to continue to rise, many of the leading prognosticators. However, we'll see what happens. I can't predict that, but this is what it looks like on a graph. So January 2020 to today. So they were up near 4 in January 2020. And if you've talked to me before about mortgage rates, I'll usually say like December of 2019. The difference between that and today, payments are so different considering this is what's happened. You've seen that. So almost 4 all the way down into the low or the mid to upper 2s. And then boom, it spiked up here to 3.02. So even if it stays here, we're still significantly lower than we were back in January 2020. So let's talk about forbearance a bit, because this is a big headline and I've heard this a lot from clients, and I've talked about it before in these videos as well, but we have a little bit more information now and a better graph to help explain. So there's still a bunch of people in forbearance. Generally speaking, not most folks, but at least half of the folks in forbearance are still paying their payments in full while they're in it. They went into forbearance as a just in case option. I don't know if I'll need it, I'll do it. Many have come out of forbearance already, but many, about 50.8%, are still in it and still paying their payments in full. 33.6% have worked out a repayment plan. 15.6% are still in trouble. Now, those still in trouble doesn't mean they're all going to sell, and it doesn't mean that they're all foreclosures either. Some of those folks might have a lot of equity. Remember, I've told you the stat many times that 42% of homeowners nationwide own their home free and clear. So free and clear, obviously people aren't in forbearance, but 60% of homeowners have over 60% equity. So a lot of people have a lot of equity. They could potentially just have to sell their house through the normal fashions, be able to pay all the fees and just get out of it. Some folks, however, will have to go through the foreclosure process or short sale. But this is where it gets interesting. That percentage of folks is only about 325,000 people. And I say only because I'm about to make a point here. 325 sounds like a lot, 325,000. It sounds like that's a lot of inventory that's going to be hitting the market. And when you hear this on the news, they will tell you, hey, all this inventory is going to hit the market. And if all this inventory hits the market, prices will drop. Just wait for that. When in reality, context matters. And in this particular reality, this 325,000 in context is not very much. So first of all, not all of those 325,000 are going to sell. But even if they did, watch this next graph. This is the housing inventory to start each year from 2016 to 2021. As you can, and by the way, we've had under 3 months of inventory, under 4 nationwide, but under 3 here in the South Bay for this entire time. So 939,000 in 2016, 825 in 2017, 764,000 in 2018. You can see inventory has been getting less and less and less. And right now we've got 325,000 inventory right now. If you add every single one of those in trouble properties in foreclosures, you still don't equal the amount of inventory that we had to start each of the last 5 years. Now think about all the demand we have right now because interest rates are so low. We can more than handle this potential supply that's coming. In fact, more people will get homes, which will be fantastic. But we don't want to root for anybody to be foreclosed. I'm just trying to make the point that even if every single one of those people decides to sell their home and sells out or has to foreclose or whatever, every January these past years, we will still have more inventory than that. It won't affect the graph of demand versus supply. We'll still have more demand than we have supply. It won't really affect prices besides maybe slow the increase of pricing because we have more places to choose from. But in general, this is a great graph to help everyone realize that we have so little inventory right now. This is why it's the best sellers market we've ever seen. And even if this happens, we still don't have as much as we had before. To help further drive that in, we've got year-over-year change in listings. So this is how many listings, total listings, and new listings. As you can see, year-over-year new listings has been under all year, and then this year it's even worse. And so this is why our total listings is where it was on that last graph. And then inventory levels. Generally, the past 5 years, we've been somewhere in here. 3 to 4, which is still a seller's market. If you've been in the South Bay the past 5 years, you've known it's been a seller's market for a long time here. We've had lower inventory. under 4 months inventory is low inventory. But this past 6 months, I mean, geez, this is why it's one of the greatest sellers markets of all time, because interest rates are low and the inventory is crazy low. So many folks that are trying to take advantage of this and sell their homes for high prices are also locking in their low interest rate on their next purchase. So we need more inventory. If you've been thinking about selling your house, you've been thinking about making that move, downsizing, you can lock in that low interest rate on your next property. And we can talk about that later. If you're thinking about buying a $500,000 loan or $1 million loan or $1.5 million loan, all of those are the lowest payments we've ever seen. The interest did rise a little bit just now, but still payments are incredibly low right now. So homes are still very affordable in terms of comparison to median income in the area. And that is your South Bay specific market update for March. Thanks. Hey, thank you so much for watching my video and on this channel. If you're on YouTube, please don't forget to like and subscribe so you get more videos like this and more videos that are South Bay specific on Redondo Beach and the rest of the South Bay. Also, you can find me at Sold by Garrison on both Facebook and Instagram. And you can also email me at garrison@soldbygarrison.com. I look forward to speaking with you in the future. Thanks again. I'll see you next time.